Hello and welcome back, everybody. My name is Derek Lalliberté. I'm an equity research analyst here at ABG, covering primarily investment company and media stocks. And have the great pleasure for the next presentation to have the investment company VEF with me, and Henrik Stenlund, who is the CFO and head of investor relations at VEF. So with that, I think we'll take it away and please go ahead with your presentation, Henrik.
Thanks, Derek. Indeed, great to be here. It's a short time, so let's just jump straight into it. So VEF, we're an investment company, as mentioned. We operate in the private space across the emerging world, fast-growing frontier and emerging markets, and we invest in fintech assets across those markets. We are listed on Nasdaq First North. Our latest reported NAV was $762 million. This is per end of Q4. We have a healthy cash position with roughly 60 million, some firepower to continue investing. And we have seen 18 holdings in the portfolio since inception, and we made 4 exits. And I will talk about the 2 successful ones quickly later on. From a historic point of view, we have delivered 30+% IRR on a NAV per share basis, which we're quite happy about and hope to be able to continue that trajectory over time. So our investment mandate, what do we do and how do we invest? We target, from a sector perspective, all types of financial services companies or fintechs across these markets. And it can be credit, PFMs, payments, investments, and even embedded fintech, which is a new area for us that we're putting more and more focus on. On the right-hand side of this slide, you see where we have touch points in the portfolio with the green dots. From a geographical point of view, we target the scale markets. Hence, we are very focused on Brazil, Mexico, Pakistan, India, certain countries in Africa, etc. So large-scale emerging markets, that's what we like. We typically take minority stakes and board seats. We have representation in most of the companies, with the exception of a few smaller holdings where we have around 1% ownership, which is an exception. But we're very active owners, and we spend a lot of time with the portfolio. We like to think that we're a unique investment vehicle. There are very few ways to play this theme across the emerging world, and we have managed to compile a very hard-to-replicate portfolio. So if you are interested in this theme, the fast-growth emerging market, fintech-focused space, this is one of the obvious ways to play that theme. We have a very diversified portfolio, both from a geographical point of view, but also from a sector point of view and stage point of view. But as you can see on this slide, the 3 core geographies for us is Brazil, Mexico, and India. That's where we're putting most of the efforts and work to grow this. On the right-hand side, on the pie chart, you can see a different representation of the portfolio, where some or a few names are starting to break out and becoming an even larger part of our NAV. Creditas being the obvious one, representing 52% roughly of our total NAV. So that's one of the companies that in order to understand VEF, you need to understand Creditas, because it's such an integral part of what we do and what we are. Second and third names, Konfio and JustPay, I will touch briefly upon as well going forward. It's been a very busy year for us. We looked at over 300 deals, and we pulled the trigger on 1 or 2 new deals this year. So it's a very thin needle eye to pass through. Again, some history. Generally, it's been a very good performance for us, with a NAV per share development generally going up, with a few exceptions. You see there in Q1 of 2020, at the start of the COVID pandemic, we wrote down the portfolio 25%, but since then it's been growing again very nicely. And the share price has roughly tracked the NAV per share with a few exceptions. And these numbers in terms of share price and market cap is obviously dated, as you can see. Today is a different story with the horrific things that's going on in the world. It's easy to invest money, but it's another question to get money back. And as mentioned, we've done 4 exits, 2 less successful, but 2 extremely successful. And that was in Tinkoff Bank and in Isiko Payments, a Turkish payments company, where we got in the range of 60 to 65% IRR on those investments. So we're quite happy about that, and something we hope to be able to replicate. And that's what we're working super hard to achieve. I also want to mention our shareholder structure. We have a very supportive marquee investor-based number of names with Rain Caniff from a Swedish perspective, Swedbank Robur Funds. We have Wasatch, Fidelity, Wellington. Super strong shareholder base that's been extremely supportive over time when we've been raising money. We also see a trend which is interesting, that some of those international big names are actually starting to invest directly into our portfolio besides being shareholders in VEF. Brazil, again, that's the big part of the portfolio. So I'm going to quickly touch upon why we have focused a lot on Brazil. And that's not by coincidence, it's by design that we have such a big footprint there. So it's a scale market, as mentioned. It's super important to us. It's one of the most online markets in the world. Obviously, internet penetration and smartphone penetration is what's driving much of the distribution around the financial services companies or the fintechs in these markets. It's a very revenue-rich market in terms of unit economics. Brazilians are paying some of the highest interest rates anywhere in the world, while the banks are charging tremendously high fees on all their services as well. And it's a well-banked ecosystem, which means that many of the consumers are sort of acquainted with financial services. So it's not so much a case of educating everyone, but rather offering better, smoother, and more efficient and better priced products to the customers. Obviously, operating in the fintech space, regulatory landscape is super important, and Brazil has had a very friendly and enabling central bank that's been supportive of the fintechs coming out of that geography. Great people and ecosystem, both from an entrepreneurial perspective, but also from a co-investment perspective, because we do invest with the local VCs in each and every market, which is super important for what we do. And last but not least, it's a very functioning exit market. We've seen names like Pags, Stone, more recently Nubank, XP making tremendous exits and IPOs in that market. And again, the 56% of our NAV is represented by mostly Creditas. It's over 90% of the Brazilian exposure. Creditas is a digital secured lending platform focused on consumers, and they leverage the assets of the core assets of their consumer base, which is their cars, their homes, and their salary or the payroll. So Creditas is building a focused ecosystem around these assets, providing loans. And this is in a country where, again, Brazilians are paying some of the highest interest rates anywhere in the world. At the same time, roughly 70% of all the cars and homes in Brazil are owned debt-free. But they're super leveraged on the unsecured consumer side, which is heavily priced and just far too expensive. And this is where Creditas is offering an alternative to them. Very fast growing company, and this is the company that's probably the most impactful for us in the near and midterm, given the size of the NAV, but also the fast growth. They're growing about 3x a year. Latest reported numbers show a loan portfolio of 3.7 billion Brazilian reais, which is the equivalent of $725 million of a loan book, and that's secured. Everything is secured in this case. This slide is just to give you some visuals on the development of Creditas, how fast they are growing. So most of the metrics are pointing up and to the right, as you can see, besides the net income. And that's driven by the aggressive growth and investments in product and services. But very healthy unit economics in this company. And again, getting ready to IPO. They're getting IPO ready sometime in 2022. Quickly moving on to Mexico. our second geography of focus, where we have 2 investments, and again, completely driven by Konfío, our second largest holding. Mexico it's a big country, as many of the countries where we invest, and they have a very big number of SMEs. The SME space is generally unloved, we feel, across the globe, and Mexico is not a different story in that regard. Roughly 7 million SMEs operating in the country, while the banks are focused on only the corporate side, the big, large companies, and the retail, the high-end retail, so to speak, in the banking system. And less than 10% of those SMEs actually have access to credit. And that's where Konfío started as a digital lending platform, unsecured, focused on the SME space. Today, this is also a very fast growth company. Today, Konfío is a digital SME bank in the making. They have applied for a banking license, and they are exploring different avenues to acquire one. And a company growing roughly 2 to 3x a year on most of the metrics as well. I think in terms of size and shape, it's probably 18 to 24 months behind Creditas as a comparison. And these companies are evolving very, very quickly. So being a pure digital lending platform has now become, again, a digital bank in the making, but also a 3-pillar-based strategy where they now have started to offer ERP, think Fort Knox as a reference, but also payments, B2B payments and B2C payments. So that is sort of creating a holy trinity, if you wish, and catering to most of the needs that the SME space has. The core still being the credit side, of course, with their unique tech that's supporting that. But very well-funded company. And if you're more interested in Konfío, I suggest you go to our website and watch one of the investor webinars, which is available, where David Arano, the founder, is giving some more flavor on that. Last but not least, India. 9% of our NAV, and one of the geographies becoming more and more important. We spent 5 years roughly looking at and researching India before we actually found our first investment that ticked all our investment criteria. And that was JustPay. We now have 3 holdings there. Super happy about that, and we look to add more over time. But JustPay is a very unique company that I would like to spend maybe 2 minutes on. First of all, India. Scale market, that's knocking in open doors, obviously to say, but it's also one of the most advanced and complex digital payments infrastructures operating in that country. And India was also one of the first countries to mandate 2-factor authentication for digital payments. That, in combination with the extreme number of different payments options which is available in India, you have a big number of different wallets. You have credit cards, debit cards, QR codes, BNPL type of payments, UPI, etc., etc. And those 2 factors in combination is creating a tremendous friction for many of the merchants. And the consequence of that is that the conversion rates at the checkout is being hurt. And that's where JustPay comes in. So they're a very tech-focused company, and they've built a unifying layer that sort of solves for the 2-factor authentication and has value-added services that increases the conversion rate for the merchants. And the client base that they're working with is Amazon, Uber, Flipkart, Ola, Swiggy, Geo Group. So one of the biggest, or some of the biggest merchants operating digitally in India. That's their client base. A fantastic company, extremely well positioned and uniquely positioned in the payments ecosystem in India, effectively operating more as a SaaS company, if you wish, but they're deriving the revenues as a payments company, meaning by a per transaction basis. Now, India is known, and many of you know this, the take rates in India are tiny, It's a different world compared to Brazil with the juicy economics that we talked about. So this is a volume game. And if you look at the volumes that are passing through the pipes of JustPay on a yearly basis, from a GMV perspective, it's $75 billion, and they are facilitating more than 8 million transactions per day. So a company that is extremely well positioned in the ecosystem, set to grow, and also growing with a growing market. And this slide is just to provide you with some more color on their relative positioning with their peers. There are no exact peer, to be quite frank. They are super unique here. But also in terms of payments volumes and the trajectory with UPI payments, which is the public free infrastructure in India. So they are growing with their merchants and the market. We have extremely high hopes for JustPay, and they recently raised money as well, like the top end of our portfolio. Maybe just a quick summary before we close this. So NAV is continuing to reach new highs. We delivered the highest NAV and NAV per share since inception at the end of this year. Creditas, again, understand Creditas if you want to understand VEF. It remains the key asset for us, and we can see that the imminent impact on NAV will come from Creditas, probably. In the current volatile market conditions, I think it's important to touch upon how the portfolio from a funding perspective looks as well. And the top 5 of our holdings, which represents 80% roughly of our NAV, are well financed and recently raised money. So they don't need to tap the capital markets in the short term, which provides us with a big comfort. We see the investors increasingly investing alongside us directly into our portfolio, which is a testament to that we are doing something right. And we have a tremendous pipeline of new companies, and we hope to be able to communicate some new exciting investments in the near future. And I think that's it for me.
Thank you very much, Henrik. That's certainly very, very exciting. So as a first question, I was wondering if I'm sure a lot of investors are curious in which of your holdings do you see the most upside from an IRR perspective right now? I know that Creditas is such a large holding in your portfolio, but if you just look at the sort of absolute upside in the individual holdings.
I think it's easy to revert to the very small holdings in the company if you look from an IRR perspective. But in terms of absolute dollar terms, I still believe in the short term that Creditas is the case at this stage. Again, as mentioned, they are getting ready to IPO, to get in a position where they can decide depending on markets, etc. It's election year in Brazil this year as well. So many moving parts, but yeah, we have high hopes for that. But then again, with the type of growth rates that you see across the top end of the portfolio, companies growing 2 to 3x on a yearly basis, that's compounding, which means that the potential NAV impact can be significant from more companies than Creditas. But we are long term. We look at 5 to 7 year investment horizons, even longer, depending on a case by case basis.
That's really clear. Thank you.
Yeah.
And with regards to Creditas, I'm not sure how connected this is, but we had this recent IPO of you mentioned the Brazilian
New bank,
yes, right, which has been quite weak, I think, in the initial trading here. Can you say, has that in any way affected your sort of influenced how you're thinking about a potential Creditas IPO?
Yeah, not really. Clearly, we are very aware of anything happening in the capital markets, and specifically when it comes to fintech peers, if you wish. Now, Nubank is a digital bank. It's very different from Creditas, which is an asset-focused ecosystem, right? But they have collaboration. They have a strategic partnership where Creditas will start to offer their services into the 34 or 35 million people customer base of Nubank, which is tremendously exciting. But I think from an IPO perspective, we need to look at Creditas from a standalone basis, even though we know that markets will obviously look at Nubank, of course. then I think there are as many views. I think I read maybe 5 or 7 different analysts' coverage of Nubank, and there are similarities, but there are also different views on their ability to generate revenues and how sustainable the growth is, etc., etc. So I think we pay attention to the outside, but we focus on the actual asset in this case, which is Creditas.
That's really clear. Thanks for that. And also, I mean, you mentioned that. From a funding need perspective, the portfolio looks really good, and also your balance sheet is exceptionally strong as well. But when it comes to Creditas, if that listing were not to occur this year in 2022, but in say 2023 instead, would you consider the company still fully funded up until in that case as well, or would you require an additional funding round?
So I would look at it from this perspective. I would say yes, they are well funded, for sure. They recently raised $230 million, I think, just by year end. So they're exceptionally well funded today. But the level of funding is correlated with the growth of the company as well. So it is within the realm to decide whether they want to stay, depending on IPO or not, how aggressively they want to pursue and acquire customers and make acquisitions, which they have down the line. They're evolving the business model constantly. So we're not afraid in that regard. And also just I think it's important to mention. I mentioned the Q1 of 2020 when the COVID hit, and what Creditas did at that point, they just stopped customer acquisition spending, and they turned cash flow positive in 3 weeks. So the unit economics are there. So it's more a question of decision as opposed to can we make it. So we feel they're in a good position. At this stage.
Okay, yeah, that's a comfortable place to be in, for sure.
Well, it's 52% of our NAV, so we need to be comfortable.
Right. I get it. And since you're investing in fintech and the financial space clearly, and we have this macro environment with talk of higher inflation and interest rates as well. Can you in some way generalize like what would the impact be on the portfolio or the portfolio companies from higher interest rates? Is that positive or negative for the portfolio as a whole?
Look, I think most of the models are sort of interconnected with and will be adjusted for rate hikes over time. You will naturally see a lag, but in the case of Creditas, again, the duration of the portfolio is connected to the funding of that specific portfolio, because they're an asset-light business and they're raising FIDICs, external funding vehicles, and the duration is connected to the loans as well, and the pricing is interconnected. So I don't really see a big risk, but obviously, rate hikes will put pressure on everyone in some shape or form. That's my sense.
All right, and as a final question, you have this. You're looking to list on the Nasdaq, the main Nasdaq market later this year. Could you give us an update on the progress there where we're at?
Indeed, we do. This is something we've been discussing for a long time, and it's a serious move, we think, and a necessary one. We have grown quite significantly over the last couple of years, and I think we feel ready to move to the main board to provide more liquidity, hopefully. Will it help with our traded discount? I don't know, hopefully. But more investors will be able to own us, also from an international perspective. And I think we guided the market and said that sometime in Q2 or Q3 we are planning to IPO and relist. So that's in the making. It's a lot of work going on at the office at the moment, preparing for this. But we keep the plan, and it's all positive.
Sounds good.
Yeah,
we look forward to that. I think that's all we have time for right now. Thank you very much, Henrik, for for participating at this seminar. You're always welcome here, and thank you everybody for listening in, and we look forward to the next presentation in about 5 minutes. Thank you.
Perfect.